So I was looking at this Bull and Bear report, and or this video from the Bull and Bear report. It must have been made a few days ago. And basically, there were some good points as well. Have a diversified portfolio. Good idea. But it just seems that many individuals like him, not hating on him, okay? And there are individuals in the alternative media as well that are getting really bullish, and I'm starting to think, okay, we see margin debt at an all-time high. We start to see a lot of bullish sentiment in this marketplace. And sure, you could see that earnings have not collapsed, right? The way that Wall Street looks at it, right? I mean, you may think that the earnings numbers are crap, right? Based on phony accounting, based on buying back their shares outstanding to artificially increase the earnings per share, right? So you could have a different interpretation of earnings, but you have to remember Wall Street's in charge. These central bankers are in charge. And a lot of people are saying that, hey, the Fed and the Bank of Japan and the ECB, all they're going to do, they're just going to flood liquidity into the system. We're going to have this hyperinflation, right? Not that I doubt that we're going to get nasty inflation down the road, but in order to see the nasty inflation a lot of us are talking about, what I've talked about, is that banks have to start lending because of fractional reserve lending. And I'm going to show you a few videos that I saw, or a few podcasts that I listened to that I will recommend you guys to listen to. And I'll talk about it a little later on. But when it comes to the market, right? Like I mentioned earlier last week in some podcasts before, I'm getting bearish, right? For the next few years, I see this market going down potentially to 11,700. Now that being said, I want to show you a few things. Alright, everyone talks about this hyperinflation, like I mentioned before. But if you want to look at like the Baltic Dry Index, right? If you look at the numbers since 2008, you could see that this chart has dramatically declined, right? You could say that there's a 90% pullback, right, in the Baltic Dry Index since 2008. And that doesn't mean that we have deflation. Excuse me. This doesn't mean that we have deflation, but it means that we have slower economic growth. But the only thing keeping us afloat is the Federal Reserve keeping interest rates at zero. In addition to that, the government could borrow all this money. All the credit is going to the US government. I could show you again with the Z1 figure. Alright, so what I want to show you again is this total credit market debt outstanding, which the Federal Reserve produces, right? This is a measure that the mainstream media does not really look at. Economists don't really look at credit. And this is why I like looking at it, right? What's talked about in the mainstream media? They talk about CPI, PPI, and all that stuff. It's all rigged, right? But when you're looking at credit, right, no one's talking about it. So I want to look at items that no one's talking about. The mainstream media is not covering. So they're not hyping over this. So I like looking at these measures. So let's just look at from 2008 to roughly right now. Or we could do 2009, right? So $53 trillion total credit market debt outstanding. And if you look at it like the so-called bull market that we have, so last 4 or 5 years, total credit market debt outstanding has gone up roughly $4 billion or $4 trillion. Now I want to look at the bull market in 2003, right? The alleged bull market, whatever you want to call it. So 2003, like 33 trillion to roughly, I don't know, like 52 trillion. So you want to do the math? Let's do it right now. So 52 minus 31. So if you look at this, 67% increase in the total credit market debt outstanding, right? Now, if you want to look at what's going on right now, so you got 53 trillion starting in 2009 to like roughly 58 trillion. So 58 minus 53 divided by 53. Roughly a 10% increase over a span of 4 or 5 years. So total credit market debt outstanding, it's not increasing that much. And if you actually look at the numbers closely, a lot of it is going to government from right now. So what you see happening is you see a lot of private sector deleveraging, and at the same time, why we haven't had the deflation that Harry Dennis talked about is because of the U.S. government being able to borrow at cheap interest rates. So what does this all mean? So people are saying that Janet Yellen's gonna hyperinflate, which I've stated before, and all these other individuals saying hyperinflation right now. You know what? I think that nasty inflation could take some time to occur, and I'll show you right now. Okay, and I'm over at the Mises.org website that I like listening to, or the podcast, and reading some articles. And it says how the government wrecks the economy. And Bob Murphy, an Austrian school economist, was interviewed. And in this interview, he said something really interesting. He said that Ludwig von Mises, Austrian school economist, if he were alive today, he would have said that hyperinflation is imminent any day now, right? And he said that he probably would have stated that since 1971, where we got off that gold exchange standard. But we haven't had the hyperinflation that a lot of these Austrian school economists have been talking about. And one thing, even though I agree with them in the long run, right? Long run, we will see some nasty dislocations because of what the Federal Reserve is doing. There's no doubt in my mind about that. However, this is what's interesting about what Robert Murphy said. He said, in order to see that nasty inflation, and he was implying that we're the world's reserve currency, so we have some extra time. That's what I was getting at. But what he's saying is that when that cash comes off the sideline and gets lent out, right, and banks start making loans, that's when he believes we're going to see the nasty inflation. And I totally agree with him. But right now, interest rates are low, and I want to show you just the 10-year graph from the past. So look at this graph at the St. Louis Fed, right? You notice that the 10-year note was like, what is it, 15%? And this is 1981. Let's just look at, it's like the 1980s, right? 1979, where we started to see some nasty inflation. The 10-year was like 12.75%, right? That was huge, right? So whenever you see these higher interest rates below the market rate, right, what are you going to still have? Negative real interest rates, and as a result of that, banks are lending money, even though not as much, but still, velocity of money picks up, and you could even look at the velocity of money charts. You did see cash changing hands really quickly within a 1-year time frame. What do you see right now, right? Interest rates are low, so no one's lending money. So that's the thing that I think many of the people on YouTube don't seem to get. Even though what I'm saying right now we definitely have inflation, and the government is definitely not reporting the numbers accurately. But in order to see like 30-40% inflation, which I do believe will happen, these rates have to go up. Banks have to get excited to lend. Right now, I don't see it. So that's my point on, is hyperinflation imminent? No. So that's why I also think that the stock market could potentially correct 20-25% from here. And just another reason why I'm bearish on the marketplace. I know I'm going all over in this video, but I just still wanted to show you. Alright, so I'm looking at the Smart Money Flow Index. I think that's what it's called. And if you look at, what is it called? Right over here, some of these graphs. Right, notice the divergence, right? Whenever you see a divergence between these two lines, right, that means that there could potentially be selling pressure. And that's what usually has happened. Usually they tend to go hand in hand, and that's normal. But whenever you see a divergence, red flag in my opinion. And this author is saying that we will notice that we are still at levels last seen in 2007, which may prove to be a false tell, but should at very least be considered when making financial decisions. So what he's trying to say is that he believes that this reminds him of 2007, right? and we should be cautious. That's what he's telling us, right? It doesn't necessarily have to go that way, but when I start to see a divergence in the smart money flow index, and people could just look around for that. It's a really interesting measure, right? Whenever you see huge divergences, red flag. Tend to see sell-offs. Doesn't happen all the time based on what I've been looking at, but just need to put that in context. Anyways, guys, thanks for listening to me. Share your thoughts below, and I don't see hyperinflation yet. It's just a matter of time when you see nasty inflation. And I just want to clarify one thing if you can't see here, right? Smart index, the smart flow index is in white over here, and then the orange here is just the Dow Jones Industrial Average, right? So that's something to look at, and I'll talk to you next time around. Thanks, guys. Bye.